There is a chart almost nobody in mainstream finance talks about, not CNBC, not Bloomberg, not even the Federal Reserve. But this single chart may be the most important warning signal in global finance today. It's called SOFR volume, and don't worry, I will explain it in simple English. All you need to know is this: every time this chart spiked in the past, something broke. In 2019, the Repo crisis. In 2020, the COVID liquidity crash. In 2023, the Silicon Valley Bank collapse. And today, this chart has gone vertical, all the way to 3.4 trillion, more than 3 times higher than any previous crisis. If this much smoke is rising, where is the fire? Think of the financial system as a giant building. SOFR is the pressure inside the pipes, and whenever that pressure jumps suddenly, the walls begin to shake. In 2019, the pressure hit around 1.25 trillion. Banks suddenly stopped trusting each other overnight. The Fed had to rush in with emergency support. In 2020, the pressure rose to around 1.3 trillion. The Treasury market froze solid. The Fed launched the biggest rescue operation in modern history. In 2023, it reached around 1.4 trillion. Silicon Valley Bank collapsed in a matter of hours. Every spike was the smoke before the fire. But today, SOFR isn't 1.3 trillion. It isn't even 2 trillion. It's $3.4 trillion. This is no longer a kitchen fire. This looks like a refinery under pressure. If this were one sudden spike, we could chalk it up as a glitch. But look closely at the chart. This is a 3-year climb, almost vertical, beginning in late 2022. Slow, steady, relentless. And it tells us something uncomfortable. The financial system has quietly become dependent on trillions of dollars every single night just to function. This is not panic, this is not fear. This is a structural addiction. The system can no longer stand on its own legs. It must borrow trillions overnight, every night, just to breathe. Let's make this simple. Imagine a marketplace that opens every night after you and I go to sleep. One group shows up with cash, another shows up holding US Treasuries, basically IOUs issued by the government. The deal is straightforward. You give me cash tonight, I will give you my treasury as collateral. Tomorrow we reverse the trade. This nightly ritual is how the entire financial system gets its oxygen. And who is borrowing all this cash? Big banks, Wall Street dealers, hedge funds, investment firms running massive positions. But who is lending the cash? Money market funds, Fannie Mae and Freddie Mac, large corporations with excess liquidity, government-backed pools of cash. This is the financial system's overnight breathing machine. Now think about this. 3.4 trillion borrowed in a single night means the US financial system must refinance that amount every 24 hours. Or it begins to seize up. This is not normal, this is not healthy, this is not stable. This is exactly how addiction looks. If overnight lending slows even a bit, if one major lender steps away, if one big player fails to roll over their funding, the pressure becomes unbearable. This is how cracks begin to form. And as if the SOFR spike wasn't enough, this week alone we saw 3 more alarms. First, the Federal Reserve injected $25 billion into the banking system in just 48 hours. This is not routine, this is emergency support. Second, the Treasury launched a buyback and purchased $12.5 billion in distressed bonds. Dealers actually tried to dump $34 billion. Treasury could only absorb whatever it could. And third, SOFR volume surged to 3.4 trillion, the highest in history. 1 alarm is concern, 2 alarms are stress, 3 in the same week. This is systemic pressure. The plumbing is shaking. So what happens when a system this fragile faces real stress? Several things can crack. First, the bond market. When big players need cash urgently, they sell treasuries. If too many sell at once, prices fall, yields spike, banks take losses, and the heart of the financial system begins to fibrillate. Second, hedge funds. Most of them rely heavily on overnight borrowing. If funding tightens even slightly, they are forced to unwind huge positions. And it only takes one major unwind to trigger a chain reaction. Third, regional banks. Silicon Valley Bank was not a one-off. Small and mid-sized banks simply cannot survive sudden liquidity shocks. And finally, the global ripple. US Treasuries are the foundation of world finance. A crack in America's funding market spreads instantly to Japan, Europe, China, and the Middle East. When the foundation shakes, every building connected to it feels the tremor. Liquidity stress always arrives quietly, and it's always felt long before the headlines report it. History shows us in 2019, repo stress turned into a crisis in 2 months. In 2020, the SOFR spike turned into a market crash in 3 weeks. In 2023, the rise in SOFR turned into a bank failure in 10 days. We cannot give exact dates this time, but with SOFR about 3 trillion, the system is already in the danger zone. The fuse is lit, but the length of the fuse is unknown. Can ending QT solve this? Stopping the Fed from pulling money out of the system would reduce some pressure, but it does not touch the core problem. The system needs trillions every night. Ending QT slows the bleeding. It does not heal the wound. With nearly 100 trillion in combined public and private debt, the options are painfully limited for the US government. They can print more money, but that weakens the dollar. They can borrow more, but that pushes interest rates even higher. They can create new lending facilities and silent backdoor rescues and hope nobody notices. Or they can let inflation run hot, quietly shrinking the real value of the debt over time. They won't say this out loud, but inflation is the easiest escape valve. In 2000, we had the dot-com bubble, a bubble in stock prices. In 2008, we had the global financial crisis, a bubble in credit. But 2025, this is something new. This is the liquidity bubble, a bubble in the need for liquidity itself. The system must now roll over trillions every night. It must borrow endlessly. It must pray that nothing interrupts the chain. Because when the need for liquidity becomes the bubble, that is the end of a monetary cycle. That is when the system needs more and more fuel just to stay alive. And if you want proof this is global, just look at Japan. Japan's 40-year bond yield had surged to its highest level in years. When the world's most tightly controlled bond market starts cracking, the shock waves ripple across the globe. Investors pull back from US bonds, funding needs rise, and SOFR explodes even higher. This is not an American problem, this is a global pressure point. But there is also a bright side. In every major reset in history, real assets rise. Gold strengthens, silver accelerates, commodities gain momentum, energy and land become more valuable, strong economies gain leverage, weak ones are exposed. When money becomes unstable, people move toward things that cannot be printed. The SOFR chart is not just a number, it's a story of a system running faster and faster just to stay in place, a story of pressure building quietly beneath the surface, a story of warnings appearing long before the world sees the consequences. And like every major shift in financial history, it does not begin with a crash, it begins with the signals. The $25 billion Fed injection, the $12.5 billion Treasury buyback, and the $3.4 trillion in overnight funding. 3 alarms, 3 warnings, the system is speaking. All we have to do is listen. This is MarketVelugu, Light on Markets.